welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of American Express Company, ticker symbol AXP. We're looking at American Express today because the company has been one of the mainstays in Berkshire Hathaway's public equities portfolio since the 1990s. Berkshire Hathaway owns more than 20% of the business, and back when Warren Buffett ran his Buffett partnerships, American Express was one of the partnership's largest positions more than 60 years ago. Additionally, American Express is also owned by a number of other value investors, including Chris Davis and Guy Spear. So currently the business is trading for $181.33 per share. Over the last year, their stock price is down 5.5%. Over 5 years, however, American Express is compounding their stock price at a rate of 13.5% annually. Over 10 years, the company is compounding its stock price at 11% annually. And going back prior to the global financial crisis, over the last nearly 18 years, American Express is compounding its stock price at about 7% annually. Keep in mind that the company does pay out dividends. Currently, they have a 1.1% dividend yield, and this average dividend yield throughout the nearly 2-decade time span we're looking at would be in addition to this compounded annual return. So American Express is currently trading for $18 below their 52-week high. The business is up $50 from its 52-week low. And American Express is a very large business. They have a $133 billion market cap, and not many of their shares are currently sold short. For additional background about the business, American Express is a global financial institution operating in about 130 countries. It provides consumers and businesses charge and credit card payment products. The company also operates a highly profitable merchant payment network. Since 2018, it has operated in 3 segments: Global Consumer Services, Global Commercial Services, and Global Merchant and Network Services. In addition to payment products, the company's commercial business offers expense management tools, consulting services, and business loans. American Express sells its products and services to consumers, small businesses, mid-sized companies, and large corporations through both mobile and online applications, third-party vendors and business partners, direct mail, telephone, in-house sales teams, and direct response advertising. American Express Company was founded in 1850 and is headquartered in the Big Apple, New York, New York. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of American Express based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off for metric number 1, for American Express, because they're a financial company, we want their return on equity to be above 14%. If this is the case, this is potentially going to give us a benchmark for American Express's return on equity to be about twice as good as that of a typical financial business. So throughout this period, American Express's lowest return on equity was about 13.5% in 2020. Since then, their returns have sharply increased. They've earned more than 30% return on equity in 2021 and 2022. And over these last 5 fiscal years, American Express's average return on equity is about 29%. That's about 4 times better than that of a typical financial business and twice as good as that benchmark we're looking for. So this is a very strong check to start things off here on metric number 1. Next up for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time, American Express has grown their revenues by about 37%. They've had moderate revenue growth. Their earnings are up by about 11% over these last 5 years, and their free cash flows is where the business really shines. They've increased their free cash flows by nearly 2.5 times, and from 2020 until 2022 alone, the business's free cash flows have increased by about 5 times. So this is very strong growth across the board here for American Express. This is a check on metric number 2. And it's especially great to see such strong free cash flow growth leading the charge for American Express's growth here, because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to buy back shares, pay down debt, pay dividends, reinvest back in the business, or make acquisitions. So ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So great to see such strong growth for American Express here. This is another check again on metric number 2. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at American Express on a per share basis. So we're looking for earnings per share growth over the last 5 years for the business. So we learned in our previous metric that their earnings have increased by about 11% over this time frame. However, their earnings per share are up at a rate that's even faster than this, and this is because the company has bought back about 12.5% of their shares outstanding over their last 5 years alone. So this is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business buys back its stock by decreasing the number of shares that they have outstanding, they're increasing your ownership percentage in the business, which ultimately will increase the percentage of the business's profits that you're entitled to as an owner. So they're doing this without you having to spend a dime, and it's almost as if the company is making a partial acquisition of itself. So just like any other acquisition, we want the company to be getting more value than the price that they're paying. And so in practical terms, we want a business to be buying back shares when the company's stock price is trading for below their intrinsic value, and it looks like an attractive use of the business's capital relative to some of their other opportunities. Again, with these strong share buybacks and slight earnings growth over this period, this is strong earnings per share growth here for American Express. This is another check on metric number 3. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Their free cash flows have grown at a very fast rate over this period, so that strong free cash flow growth in addition to their share buybacks has led to very strong free cash flow per share growth for the business. American Express has produced $25.60 worth of free cash flow in their last fiscal year alone, so this is another check here on metric number 4. So far, so good for American Express. We are a perfect 4 for 4 through our first 4 metrics. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. American Express's debt profile is going to look a little different because they're a financial business compared to some of the other businesses that we've looked at. However, for this metric, we still want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. American Express has significantly reduced their net debt position over this time. They ended their most recent fiscal year with $11.6 billion worth of net debt. And over the last 5 years, American Express has produced about $56 billion worth of free cash flow. So they are massively cash flow generative relative to the debt that they're employing in their business. Over their last 12 months, American Express has produced $19.2 billion worth of free cash flow. So they'd be able to pay off all of their net debt with about 3/4 of their current free cash flows. So this is a big check here on metric number 5, as the business is strongly cash flow generative relative to the leverage that they're employing. We're still perfect through our first 5 metrics for American Express. Let's see if the business has what it takes to become a select 6 stock. So our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. So if this is the case, this will potentially offer us a reasonable starting point for evaluation of the business and potentially offer us a slight risk premium to the yield of the 10-year treasury. Again, because they're a financial business, their enterprise value is going to be a little different than that of a typical business. So American Express has a $133.4 billion market cap, and we learned that the business has $11.6 billion worth of net debt, meaning that their total enterprise value is around $145 billion. So we're utilizing their enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of all of the capital that's involved in the business that'll help us analyze the business more similarly to as if American Express were a private company. So we learned in our previous metric that the business has produced $56 billion worth of free cash flow over their last 5 fiscal years, meaning that in an average year, American Express produces about $11.2 billion worth of free cash flow. So when we divide their $11.2 billion of their average free cash flow by their $145 billion total enterprise value, that gives us about a 7.7% average free cash flow to enterprise value yield for American Express. That's about several percentage points above that 5% risk premium that we're ideally seeking. It's also more than double the yield of the 10-year treasury currently. And so this is a check here on metric number 6, meaning that American Express has done it. They are a perfect 6 for 6 on our analysis today, and it looks like the business is potentially offering that attractive risk premium. Just because American Express does well on our analysis, and this is a check here, this doesn't mean that you're going to run out and go buy the business. This type of analysis is just a starting point, and it's meant to be holistic. It's not financial advice, and it's not a buy or sell recommendation of any security. While these metrics are simple, when they're combined together, they can be very powerful. There are a couple other things you want to be mindful of here as well. One is that over their last 12 months, the business has produced $19.2 billion worth of free cash flow, which is pretty significantly above where they have been at historically. So to get a current free cash flow to enterprise value yield for American Express, When we divide their $19.2 billion of their most recent free cash flows by their $145 billion total enterprise value, that gives us about a 13.2% current free cash flow to enterprise value yield for the business. That again is significantly above that 5% risk premium. So American Express could really be a business that's worth digging into and learning more about, especially given this business's strong showing and its track record of being held long-term by esteemed value investors. But before you run out and go do that additional research, we've got some interesting aspects of the business left to cover. So as a bonus, here we're looking at American Express's dividend profile. So American Express currently pays out a 1.1% dividend yield. We still want to look at the business's dividends to understand whether they're supported by the company's earnings or their free cash flows. For American Express, we want their dividends to be supported by their free cash flows, and that's been the case in all 5 of these years. American Express has grown their dividends throughout this time frame, and they've also grown their free cash flows per share, along the way maintaining a seemingly very modest and very reasonable dividend payout ratio. And so even though this is a snapshot of the last 5 years of their performance here, it looks like American Express's dividend is likely in good, sustainable shape, and it would seem that the business is continuing to prioritize returning capital to shareholders, both through their buybacks and their increasing dividends. Everything we've covered so far is important, but there's something missing that, in my opinion, is the main reason to analyze American Express, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for American Express. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're using an average of their free cash flows over their last 3 years to give us a potentially more normative perspective of the business's abilities to produce free cash flows. Then we're using historical growth assumptions for how American Express has grown their free cash flows, dating back all the way till 1990 in order to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward for the business. So if we assume that American Express grows their average free cash flows at a rate of 6% annually for the next 10 years, and then their free cash flows decline to growing at a rate of 4% annually for the 10 years out after that, if we add in the company's tangible book value, which gives us a perspective of their tangible net worth per share, and we were ideally seeking a 15% rate of return from American Express, which is the rate of return that Warren Buffett is ideally looking for from his investment positions, in addition to his margin of safety requirements, depending on his understanding of the competitive dynamics of an industry and a business's durable competitive advantages within that industry. Then from today's valuations, it looks like a potential fair value for American Express is right around $146 per share. That's down about $35 from American Express's current stock price, but that's more than $16 above the business's 52-week low. So it's well within the range of where American Express has traded over the past year. It does look like at today's prices, there would not be a potential margin of safety here with this 15% rate of return as your requirement. Please be mindful of a couple of things here. One is that this is just an estimate going forward into the future. 2 is that this discount rate would be including their dividend yield, so we would not be doubly counting their dividends. 3 is that a discounted cash flow model is based off the predictability of a business's future free cash flows. American Express, throughout its history, has tended to have very stable and very steady predictability in terms of their free cash flows, and the business ranks quite highly in terms of their overall predictability, which has really been one of the key hallmarks of how Warren Buffett has approached investing. He's really maintained patience and really looked for high probability outcomes. And American Express's overall business predictability seems to fit that almost to a T, as he has also invested in the business at multiple points, taking significant positions in the company throughout his extremely long investment career. Then finally, please be mindful of the fact that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll talk about our summary for American Express, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points for either a potential long or potential short thesis of the company? So starting with some of the key points around a potential long thesis for American Express. Number 1, American Express's efforts to reposition its cards as lifestyle products for younger card holders has been a success, and new card acquisition has risen significantly. Number 2, American Express's strong position with small businesses should help it win additional business-to-business payment volume as the company seeks to expand its offerings in the space. And number 3, American Express operates as a closed-loop network for the cards that it issues. This allows it to capture more of the economic profit of a single credit card payment than other credit card issuers. Then for some of the key points supporting a potential short thesis of the business. Number 1, business travel will likely struggle to return to pre-pandemic levels, creating a prolonged loss of purchasing volume for the firm from this sector. Number 2, despite much improved acceptance rates in the United States, the company will need to work against the negative perception that its cards are often rejected by merchants. And number 3, American Express operates with a narrower scope than many of its competitors, offering fewer deposit and lending products than other credit card issuers. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of American Express. Now it's time for our wrap-up. So in summary, American Express is a perfect Select 6 stock. The business was flawless through our 6 metrics. As for a financial business, they earn significantly above average returns on equity. Their revenues, earnings, and free cash flows have grown over the last 5 years, as the company has bought back 12.5% of their shares outstanding. They also look like they're very cash flow generative relative to the debt that's employed in the business. On both a current and an average basis of their free cash flows to their enterprise value, it looks like American Express would be giving a risk premium to the yield of the 10-year treasury. Looking at their dividend profile, it looks like their dividend has been growing over the past 5 years, and that American Express has healthily and easily supported their dividend in all 5 of these years. That seems like it could potentially continue into the future as well. Finally, performing a discounted cash flow analysis of American Express. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the business, and you are ideally seeking a 15% rate of return for the business, then it looks like at today's valuations, a potentially fair intrinsic value for American Express is right around $146 per share. So again, there are reasons why this may not be potentially accurate and applicable for the business. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about the business. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a company, and you can truly understand the ins and outs of that business, learning about the company accurately, completely, and then going back and asking yourself, what did you miss, in order to come to the underlying essence of the business. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of American Express, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of American Express Company, ticker symbol AXP. Again, we looked at the business because it's been a mainstay in Berkshire Hathaway's public equities portfolio for over 20 years now. Because of American Express's huge share buybacks over this time frame, Berkshire now owns 20% of the business. American Express is also a position in both Chris Davis's portfolio and Guy Spears' portfolio as well. And it has been a sustainable and enduring business for a significant part of American history. So I'm thrilled to make an analysis of the company, and if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about American Express with me, and have a great day.